Donald Trump's proposal for a crypto bank and a US dollar-backed stablecoin has sparked unprecedented debate among financial elites, regulators, and everyday investors across the globe who now question the future of the dollar's dominance in world markets. At the heart of the controversy is the idea that a Trump-endorsed cryptocurrency institution could rival traditional banking infrastructure, potentially offering faster payments, lower fees, and a new form of digital savings for millions of Americans and international users alike. Critics argue that introducing a USD-pegged stablecoin under the banner of Trump's crypto bank threatens established financial regulatory frameworks and could weaken the control central banks exert over monetary policy and inflation management. Proponents counter that a U.S. government-linked stablecoin might reinforce the dollar's global supremacy by bringing digital currency innovation into the mainstream with official endorsement and broad institutional support. The concept of a Trump crypto bank has drawn comparisons to past attempts by private technology companies to create digital financial services, but this effort is uniquely tied to political influence and national identity in ways never seen before. Economists warn that fusing political leadership with digital currency creation could blur the lines between monetary policy independence and partisan economic strategy, creating uncertainty in global markets that depend on dollar stability for trade and lending. Supporters of the proposal claim that a government-backed stablecoin could deliver financial inclusion to unbanked populations, offering access to modern banking services without the traditional barriers associated with brick-and-mortar institutions. At the same time, skeptics worry that the integration of stablecoins into the national financial system might pave the way for digital surveillance of transactions, potentially jeopardizing individual privacy and civil liberties under the guise of economic modernization. Wall Street has reacted with a mix of opportunism and caution, as investment banks consider the profit potential of new crypto banking partnerships while also preparing for increased regulatory scrutiny from Washington. Regulators at the Federal Reserve and Treasury have expressed concerns that a politically affiliated crypto bank could introduce volatility into financial markets, particularly if consumers shift large deposits out of insured traditional banks. Central bankers in Europe and Asia are closely watching developments in the United States, since any significant shift in dollar usage or payment systems could influence the strategic direction of the euro, yuan, and other major currencies in global reserves. The idea of a U.S. stablecoin backed by the full faith and credit of the government has been floated in academic circles for years, but Trump's proposal accelerates the discussion into the realm of practical policymaking with immediate political implications. Blockchain developers and crypto entrepreneurs are eager to participate, seeing an opportunity to integrate decentralized finance DeFi technology into mainstream systems, potentially creating hybrid platforms that marry traditional finance with innovation. Yet legal experts caution that launching such a financial product would require massive overhauls to existing laws, including banking charters, digital asset regulation, consumer protections, and international monetary agreements. The public response has been equally polarized, with some Americans welcoming the technological leap forward and others fearing that crypto experimentation could destabilize retirement savings, mortgages, and everyday checking accounts. Internationally, U.S. allies fear that tying digital currency innovation to a specific political figure could erode confidence in the impartiality of the Federal Reserve and U.S. economic leadership across election cycles. Financial historians note that no incumbent U.S. president has ever attempted to redefine the architecture of the monetary system to this degree, marking a potential inflection point in how nations approach currency in the digital age. The proposal has unleashed a wave of speculative trading across cryptocurrency exchanges, as traders attempt to price in the likelihood of policy changes, regulatory hurdles, and public adoption rates for new digital assets. Banks in emerging markets are bracing for potential disruptions, as a U.S. stablecoin could attract capital flows away from local currencies, complicating sovereign debt services and inflation control in vulnerable economies. Advocates argue that a secure and regulated American stablecoin could counter the influence of foreign digital currencies and prevent adversarial nations from leveraging alternative payment networks to bypass U.S. sanctions. Detractors warn that the line between national security and economic hegemony could be dangerously crossed if crypto tools become instruments of political leverage rather than broader financial stability. Consumer advocates have raised alarms about the risks to everyday savers, emphasizing the need for clear disclosures, robust insurance mechanisms, and safeguards against algorithmic failures or hacking breaches that have plagued private crypto platforms. The technology underpinning stablecoins, including smart contracts and distributed ledgers, is itself revolutionary, but integrating these tools into the backbone of the U.S. financial system presents myriad technical and operational challenges. Economists have also highlighted the risk of a run on traditional banks if customers perceive the crypto bank as offering higher yields, faster services, or greater security, leading to sudden deposit outflows with systemic consequences. Political analysts say that the crypto bank narrative plays well with certain voter blocs who favor financial deregulation, innovation, and decentralized power, potentially reshaping electoral dynamics around economic issues. At the same time, policy think tanks warn that merging political ambition with monetary systems could invite unintended consequences, including increased inflationary pressures if digital currency supply outpaces productive economic activity. Global financial institutions such as the IMF and World Bank have weighed in, suggesting that stablecoins could complement existing systems but must be designed with international cooperation and regulatory harmony in mind. The specter of cyberattacks looms large, as digital financial networks become more interconnected, prompting cybersecurity experts to call for ironclad defenses before any large-scale rollout of digital dollar infrastructure. Private sector banks worry about losing market share to a crypto bank that could offer lower-cost transactions, cross-border payments without intermediaries, and algorithmic interest yields that outpace traditional savings accounts. Some investors see the proposal as a hedge against inflation and economic uncertainty, believing that digital currency could protect wealth in ways that tangible assets like gold or property cannot in a highly digitized future. Yet others caution that digital currencies remain untested under severe market stress, and a sudden crash in confidence could trigger contagion across both crypto and regulated financial markets. While dialogues continue, grassroots movements for financial democratization have rallied behind the idea of decentralized banking, viewing Trump's crypto bank as a gateway to broader economic empowerment for ordinary citizens. Regulatory agencies, however, are pushing back, insisting that any institution managing deposit-like liabilities must meet capital adequacy standards, compliance protocols, and consumer protection mandates akin to existing banks. Technologists argue that distributed ledger technology could make payment systems more efficient and transparent, reducing costs for consumers and businesses alike, but implementation remains complex and controversial. International trade partners are carefully assessing how a U.S. stablecoin might affect trade invoicing, settlement systems, and the long-established preference for dollar-denominated contracts in global commerce. The potential for geopolitical friction is significant, as rival nations may accelerate their own digital currency initiatives in response to perceived shifts in U.S. monetary influence. Market volatility has already spiked in currency pairs involving emerging market assets, as traders anticipate potential disruptions if a U.S. digital currency alters liquidity patterns or capital flows. In Washington, lawmakers are debating legislation that could either facilitate or constrain the development of digital banking entities, with sharp divides between pro-innovation and pro-stability factions. The blockchain community remains vocal, with hackathons, conferences, and white papers proliferating as developers seek to shape the architecture of a potential U.S. crypto bank from the ground up. Finance professors are revisiting monetary theory in classrooms, using the Trump crypto bank proposal as a case study of how digital currencies might intersect with fiscal policy, central banking, and international exchange dynamics. Insurance companies are evaluating new products to protect depositors and investors in a world where digital assets might coexist with or replace traditional deposit accounts. Business leaders have formed advisory councils to consult with policymakers, offering insights from Silicon Valley, Wall Street, and global financial hubs on the best ways to integrate innovation with stability. Consumer distrust in big banks, exacerbated by past financial crises, has fueled support for alternative banking models, including those built on blockchain and digital identity verification systems. Yet the question of who controls and audits the algorithms that manage currency issuance remains unresolved, raising concerns about transparency and governance in a politically charged financial environment. Economists caution that the velocity of money in a crypto-enabled economy could behave very differently from traditional systems, with implications for inflation, employment, and investment cycles that are not yet fully understood. The integration of identity verification technologies into digital currency platforms also raises privacy concerns, as citizens weigh the convenience of digital transactions against potential government monitoring. In cities around the world, entrepreneurs are preparing for a future where digital currency acceptance is widespread, reimagining point-of-sale systems, loyalty programs, and decentralized finance tools for everyday commerce. Some central banks have accelerated their own digital currency pilots in response to the U.S. debate, seeking to ensure they are not left behind in a rapidly changing monetary landscape. Academic journals have published a flurry of research examining the macroeconomic effects of stablecoins, digital bank charters, and political involvement in currency innovation, deepening the intellectual discourse. The concept of digital identity tied to financial access is gaining traction, with discussions about how such systems could streamline services but also create new risks of exclusion or profiling. As speculation mounts, the financial press tracks every regulatory filing, executive appointment, and political speech for clues about the timeline and viability of Trump's crypto bank vision and its potential stablecoin launch. Investors, regulators, and citizens alike are entering a new era of financial experimentation, where the intersections of technology, politics, and economics challenge decades of conventional monetary wisdom. Amid all the uncertainty, one thing remains clear: the conversation about Trump's crypto bank and USD stablecoin has ignited a global rethinking of what money is, who controls it, and how it should function in the digital age.